Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagerin. Hey, Doug.
Hey, Kurt, happy Friday. I think the theme of today is conflict. Conflict in the data, conflict in the Middle East, because, of course, the last, thing we've heard is that Trump said the agreement is on life support. Yeah,
There's
conflict.
no
That's what I'm
conflict in
looking
the
at.
Middle East. The war's over. Didn't you hear? And it was over a month ago, Doug.
Oh, you didn't hear
Everything's
the latest
settled.
a couple of days ago then, that it might not
No,
be.
I'm going by a month ago, Doug. The war is over. I am not paying attention anymore because the war is over. I'm just going to
Right.
put all my money in the market and watch it go to the moon. Okay?
That's exactly.
Forget reality, Doug. Come on.
To the moon.
To the moon. Oh boy, yeah, it has been a really, really interesting time since the war. Um, we're going to do a recap of a lot of it because I think I've been getting a ton of questions about this, and I think it's important just to kind of recap everybody. Um, but yeah, I will say though, my announcement last week that they're here was correct. That it was a distraction, and that what they released was a whole lot of horse manure. Okay. I didn't actually look through it. I just looked through all the other people that did to save myself some time, and everyone had a clear conclusion. Whatever was released by the government last Friday was, hey, I saw a light in the sky, but we don't have a good picture of it. Here's a grainy picture of a light, 5 miles away. Here's this
Right.
thing. Like, it's basically people submitted stuff and the government has it, and there's nothing of value in there. Exactly what what I assumed. I said this is going to be a distraction, and there was clearly nothing of value in there. There might be aliens, but we have no proof yet. So, as my youngest son says, "Show me proof." I'm like, "Well, the government hasn't done that yet." So anyway, I do not have my tinfoil hat on because I have no need because there's nothing to see here. Um, anyway, so what I wanted to kind of talk through this week is to really give a breakdown of what's actually going on in the markets. And I'll explain why. Okay. I've had a lot of conversations with clients over the last few weeks, and everyone's really confused. So we're going to kind of walk through that this week. Okay. I want to use a prior framework I used, which was there's the phase one or scenario. I won't call it scenario one, but we'll call it phase one, which is pre war. Everything up till November 28th was pretty much phase or scenario one. Scenario two is pretty much March 1st until March 31st. And then scenario three is kind of what we're in now. The war is quote unquote over, but it's not really over. And the challenge is that most people, and I'm sure most of you listen to this podcast or in this boat, where all you do is you look at the indexes and say, what have the indexes done for me lately? And we've all been conditioned that the indexes are the market and that whatever the market's doing is what the economy's doing. We're all conditioned for that, right? Wall Street, the media, everyone says this. Well, it's just invest in the index and forget about it. Well, the problem is index investing isn't always the best thing. Okay. And buy and hold isn't always the best thing. Now, sometimes it is, and sometimes it's not. In 2022, buy and hold didn't do any favors. Diversification didn't do you any favors because everything became correlated. So, what's the purpose of investing in different things if they are not providing a correlative benefit? So, if you look at um, most of recent history, up until somewhat recently, there was a correlation that you could count on. Bonds go up, stocks go down, stocks go up, bonds go down. That was a normal correlation. And if you had some stocks and some bonds, they would offset each other and it would smooth out the volatility. That's why people did it. They call it the 60-40 portfolio. Everyone was happy. Bonds made a little bit of money because your interest rates went down, stocks went up, so you made money there. Everyone's happy, right? That was a very normal portfolio for a long period of time. 2022 threw that out the window because stocks went down and bonds went down. The only thing that was safe was cash. Okay. And we saw this again in March of this year. Stocks went down, bonds went down, Everything went down except for cash. Cash was the only thing went up. The dollar went up, but everything else is, I mean, energy. I wouldn't say anything. Energy went up obviously because of energy prices, and oil went up, but virtually everything else dropped. So when you have these environments where everything correlates, your diversified portfolio is not going to do you any favors. It's not going to reduce your risk. It is not a benefit to you. Um, and frankly, when you look at how the market operates, when you are in periods like we are now, you cannot assume bonds are going to be safe. Now, we were in a period prior to this where we assumed that interest rates were going to continue to drop, myself included. Prior to the war, we assumed interest rates are going to continue to drop. My estimate was Trump wanted to retain power in the midterms. In order to do that, he needs lower interest rates, lower mortgage rates, lower inflation, lower prices, lower oil prices, all the things that middle America, Main Street care about, right? If you've got money, you probably don't care. If you don't have money, you care very much because now your transportation costs to and from work costs 50% more. You see the stories out there, people living on $50 a month because everything else goes into the utilities. That stuff's crazy. I don't know what they're doing, but maybe they should get rid of their cell phone. But whatever it is, the point is people have real problems. In order for Trump to do well in the midterms, he needs to alleviate those problems. I'm not saying he can, because those are really systematic problems that are not going to go away with lower interest rates. But the point is that would be the intention, make people feel better about themselves and feel better about Trump. Because if you want to have the Republicans maintain power in the midterms, that's what you need. Okay, just plain fact, forget policy, right? So my assumption, and a lot of other people's, was interest rates were going to go down. Most people thought they were going to go up because they think that, well, we have high inflation, and even though we can't see it, it's still there. Yeah, that's horse manure. However, now, because of the war, inflation's going red hot. We were at a time in April where the chances of a rate hike in this year were right around 12%. Really low, insignificant, almost nothing. As of a few days ago, that chance, I don't know what it is today, but as of a few days ago, I think it was, maybe 2 days ago, the chances were 31% of a rate hike this year. Now, that's relatively high. Now, if it gets up to 80%, I'd say it's a guarantee because the Fed is going to do what they have to do. But, and I say guarantee in air quotes, by the way, so I don't get in trouble. But the point is that because of the war, inflation is starting to take off. Inflation goes higher, that means interest rates go higher. Okay, it means your commodity prices are going higher. It means your earnings of your companies are going to go lower. It means companies that borrow a lot of money, like home builders or real estate companies, are going to go lower because it's going to cost more for them to borrow money. So higher interest rates negatively impacts the economy. It did in 2022 when we had inflation that hit 9 point something, 9.3, I forget the exact number, but 9 point something that year. Interest rates went up a lot more than people expected, caused the markets to go down, caused, if you were in 30-year treasuries in 2022, you lost approximately 50% of your investment, 50, for safe bonds. And I just put safe in air quotes. Safe bonds, okay? The US Treasuries are guaranteed by the government, just like your dollars. They're as safe can be, right? There's nothing as a guarantee, but they're as close to that as you can get, okay? And for your 30-year treasuries to lose 50% of their value in about a year, that's not safe. And so if you see situations like that, it's got to give you pause and say, okay, interest rates are going up. What's that going to do to the rest of my investments? Now, I've been very hesitant to make a decision on direction of markets, as we've been talking about in the show. Caution and patience. And I've been saying that because we don't know directionally. My bias is still they're trying to get lower interest rates, but the war's not stopping. The longer it goes, the longer it looks like it's going to go, which means that lower interest rates are off the table. At the moment,
Oh, wait, Kirk, it stopped. The war stopped. You just said that.
I know the war stopped. I know, but some people don't know,
Including our government. So anyway.
Yeah, well, no, our government knows. They're just playing us for dumb. They just pretend like we're stupid, and we're like, oh yeah, the war's over. Well,
Right.
apparently the stock market's dumb because the stock market's been going up, but we're going to get to that in a second. So you have to think about. So my thesis for lower interest rates was off the table a while ago, but I was giving it pause because I still have a thesis that if the war stops like tomorrow, I could very much see interest rates dropping. I'm not saying they will, but I could see it. I don't know if it'd be by election time, but okay, we could take rate hikes off the table as long as oil prices drop significantly. If they're at this level, no way in hell. If they stay at this level, no matter whether the war's on or not, interest rates are going to go higher, and inflation is going to go higher, and people are going to be screaming bloody murder. So prior to the war, scenario one, that is now off the table. All the things I thought were going to do well, throwing that game plan out. Okay. Game plan two, where everything goes down in the war. The markets haven't been showing me that. The markets are showing me that they're going up. So that game plan is on pause. I don't know if it's going to come back or not. And then you got scenario three, which is virtually everything is static except for one area that's killing it: semiconductors. Semiconductors make up, well, first of all, semiconductors are a subsect of the technology sector. The technology sector is made up of a bunch of different things. And off the top of my head, I don't know them all, but it's made up of software and semiconductors and hardware and other things. But there's a bunch of areas that make it up. Semiconductors, being part of the whole, has 30% exposure to the whole index of the S&P 500. 30% for semiconductors on an entire index of 500 stocks. There's maybe 6 to 8 stocks make up that 30%. And that's driving the value of the index. So the fact that the indexes are up right now are almost entirely due to semiconductors. Because if you look across the board, if you don't remember, go to last week's video that we did on YouTube and look at all the sectors we walked through. They're all pretty much flat. I mean, they kind of went up, they kind of go down, but they're more or less kind of holding a pattern. They're in a holding pattern. They're kind of going sideways. Now, individual stocks are going up and down. Some are rocketing up 20% on earnings. Some are going down 20% on earnings. I'm not playing that game. If you're talking about a 1% move, that's one thing. But if you report earnings, you're down or up 20%, I'm staying. That's not a game I want to play. I'm not taking a chance on that. That's just, in my opinion, is dumb. Maybe you're smarter than me, but I'm staying out of that pool. So if you look at the sectors themselves, everything's concentrated in technology, more specifically semiconductors, because software is down a lot. So if you have semiconductors going up that much and it's rocketing the index up, what do you think we should be doing? Now, I'm asking the question, to get you to think about it, because most people are knee-jerk reactions. Will just invest in semiconductors. Yeah, you can do that. You certainly can do that. I'm not saying you shouldn't. But when you look at the sector and say it's more overbought than it's been in recent history, I'm not sure I want to jump on that train. I'm not saying you don't, but it's a very risky endeavor right now, because if everything else is flat except for one area and that's rocketing up, I don't know if you guys remember what happened to silver in January. Silver dropped 50% in pretty much 24 hours. I'm pretty sure I don't want to make that bet. I'm not saying semis are going to do that, but silver did it. And even if semis don't go down 50, if they go down 20 in a day, 20%, I don't want to be on that train. So it's okay to not invest in something. And I want to say this again. It's okay to not invest in something. You don't have to invest in everything. You don't have to find all the shiny objects and all the rocket ships going up and all the hot dots. You don't have to do that. Invest in your game. Play your game. Don't play other people's games. Play your game. If you're a value investor, be a value investor. If you're a trend follower, be a trend follower. If you're a trend follower, you're probably sitting out of the markets because this is the worst market for trend following. Sideways, choppy markets are terrible for trend following. It's the worst. It's the only thing that doesn't do well. Otherwise, you follow trends and you do well. That's the thing you have to think about. Okay. So when I look at, I'm just going to share this chart. So if I'm looking at the chances of a rate hike being 31% now, rocketed up in the last few days, I don't know what caused that, but I know it was something. It doesn't matter what it was. It means everyone else came to the conclusion, oh crap, interest rates are going up. Kind of like me. I'm looking at the data saying, I think rates are going to go up, but I'm not 100% convinced because if the war stops, but now that people are seeing the war is probably not going to stop anytime soon. And Trump just had his visit with Xi, and I hear a lot of funny comments about that, like, "Oh, Trump bent the knee to Xi." Okay, so what? Like, he complimented him. Oh wow. He also said that the U.S. was a poor version of his former self. Yeah, that's true. Like I get it. And all that stuff, you can kind of ignore all that crap. I would ignore everything coming out of Beijing and what happened in the meeting. I ignore all of it. You had a lot of our business leaders over there trying to work trade deals. That's fine. I give Trump a lot of credit for bringing over his firepower to go make deals. Deals aren't made in one sitting; they're made over long periods of time. But I will say this: is that since that meeting started, the markets have not been great. And so, is it the meeting? Probably not. It's probably because the markets expected something out of that meeting, which we're probably not going to get. So, how should you invest from here? Well, if you like gambling, then you could probably take a shot on semiconductors. They're still strong compared to everything else. If you're a value investor, you might want to find some. I don't even know where you'd find value in this market. I'm not seeing too much. You can find some. But if you're invested in semis, I'd be looking for an exit. Not because it's not going to go higher, because I have no idea, but because if you made a lot of money on it, now would be a good time to take profits and just sit in the sidelines. That'd be my thing. But the takeaway that I want people to start thinking about is you can't look at the market as a binary thing. You can't just look at it and say, oh, well, it's just the index. Well, here's what the NASDAQ did. Here's what NVIDIA did. Here's what Google did. And people pick and choose their fancy. Oh, well, why are we not invested in Google? Why are we not invested in semiconductors? Why are we not invested in blah, blah, blah? Well, because we're not, right? It doesn't matter. You don't have to be in the hot dot because at some point it won't be, right? Why are we not invested in energy stocks? Well, people aren't saying, why are we not invested in software stocks? No one's saying that because software has gotten taken to the cleaners. And so have healthcare stocks. Why are we not on those? No one's saying that because they're down. They only want to be in areas that are going up. So I point this out because I've been doing this for 27 years. I've been in the markets and advising people, and I can tell you that I've seen this playbook a few times. Okay. And I don't know what's going to happen in the future, but I know a version of what could happen, and it gives me a big pause. And I'm looking at the markets, and they don't look healthy. And if we have higher interest rates, higher inflation, higher energy prices for a longer time, this is going to get a lot worse. It doesn't mean it's going to get worse tomorrow or the next day, but it's going to get worse. And people are investing in emerging markets. I wouldn't touch that with a 10-foot pole. A lot of these countries can't even get oil. So I only share all of this, not to give people a downer, especially on a Friday, but really to point out that the markets are complicated. What is happening does not always align with reality. And that's why price is the final arbiter, because semiconductors are going up. That's the arbiter. They're correct. I don't know if it makes sense. It doesn't matter if it makes sense because the price is the price. But we do have a lot of money sloshing around in this economy, and it has to go somewhere, and it was going to semis. when they're done with semis, it will go somewhere else. I don't know where that is. If this war continues, probably in energy stocks. I don't know. Maybe oil prices. Maybe oil prices go to 250, right, instead of 100 or wherever it is now. I would be very cautious, and it's going to be really hard for a lot of people to be cautious because everyone wants to be invested all the time. But if you don't have an advantage in the market, why are you putting your money at risk? That's my question. Why put your money at risk if there's no advantage to you? If you're in a game where you're flipping a coin and it's 50% chance of winning, 50% chance of losing, are you going to put your entire net worth on that coin flip? Not unless you're stupid. It doesn't make sense. You have no advantage. It's basically random chance. But if you had a 99% chance of doubling your money with with a coin flip, I would take that every day, twice on Sundays. You get a 99% chance of success. So could you be wrong? Yeah, but you're going to be right almost all the time. So it makes sense. Right now, we have, in my opinion, we've got a 20 to 30% chance that things are going to go higher from here over the next few months if the war continues. And more of a chance it'll be flat, but a reasonable chance it'll go down from here. Assuming, like I said, assuming the war stays. If the war stops tomorrow, we got to come up with new frameworks. But as of today, it doesn't look like it's going to stop anytime soon. Might even get worse. Inflation looks like it's getting worse. The markets are not pricing this in yet. That is your advantage. The markets are not pricing in this information. It looks like today they are. Today the markets are a disaster. But in general, they're not pricing in the reality. So take that caution, patience and caution, take that, and when you're looking at your portfolio, use that as a framework and don't feel like you're in a rush. If you need to sit in the sidelines and wait, sit in the sidelines and wait. Don't worry, you're missing out, because you're not. There'll always be another rocket ship going up. You didn't miss out in the only time the year you're going to make money. Believe me, there'll be plenty of times to make money. You don't have to find all of them.
Did you miss your opportunity to get PPP money during COVID? Are you waiting for our president to forgive your student loans? Are you excited about helicopter money? Me too. If you want free money, look no further. I'm giving away free money this week on our show. All I ask is 5 or 10 minutes of your time. I'm so excited to give you free money, I can hardly contain myself. Take advantage of me and my excitement to get your free money. Go to www.moneytreepodcast.com/free money. Follow the instructions today and get your free money.
Doug, what are you seeing?
Kirk, I'm seeing some things that definitely correlate to exactly what you're seeing, and reason to be cautious in the near future. We are, I think, when you talked about the emerging markets right now, first of all, I said a little bit of this last week. The entire market has kind of gone into what's, one person called a giant gamma squeeze. S&P 500 trading 2.6 trillion notional of calls the other day, which is an all-time high. So when you've got that much options trading going on, and of course calls being bullish, and wanting, protective bullish, expecting the market to go up, as opposed to, puts, which you're kind of hoping, or hoping it stays, but you're being protective of it dropping. So there's definitely this, current, at least on the retail side of things, push to a future high of the markets. And there's some reasons to think that too, and I'll come back to. Also, we are looking, as I stated before, it's a midterm election season. Midterm election seasons tend to be more volatile anyway, and that's without the Iran war. We've said this before ad nauseum, you and me. Markets don't like uncertainty, which is why the years that a two-term president is retiring is going to be typically more volatile than a re-election year, because the markets have no idea who the next president's going to be, and they don't like that. And re-election year, incumbents typically are going to be, re-elected more often than not. Although if you look at recent history over the last several presidencies, That's actually not been the case as it had been for a long time. But markets tend to say, okay, sitting president, chance of being reelected, president retiring, we don't know what we're getting. Well, same thing in a midterm election. You don't know what's going to happen to Congress, and that's not a bullish thing for a stable market. We are seeing significant, and I think this is something that is really concerning. We have started to see the prices. Most of you have witnessed this. The prices, we talked about this last week, have gone up well over $1. You know, to $1.50, and we are. This is before we start to see what they're already projecting is that many of the reserves, oil reserves around the world, are at near depletion. That means that they are in a desperate need to get more oil at a time in which there is still a ton of uncertainty as to where that oil is coming from and how it's going to get there. And they need to buy to replenish those reserves. And it's just not there. The supply chain is still broken. There's a lag time on that. And what you also have to recognize is it is May. This is the time in which you see a change in oil, in gasoline anyway, as many municipalities move to different summer blends. Chicago, for example, Colorado, California, for example. So the fact that they're already going into this season now in $5 and a gallon, I mean, you're looking going into the summer potentially $7 to $8 a gallon, right? And if that were to happen, that is an absolutely critical strain on cash flow for not only families, but transportation. Remember, the majority of our country still runs off semis driving down the highways, and they are feeling it. I'm seeing it from from the industry. They're already feeling the pinch, and they don't just absorb it, they pass that on. So it trickles down to the rest, of the society. So a lot of those things going into the summer are certainly things to be concerned about. And we've had a significant spike, I would say, not in inflation recently, a big Achilles heel for the economy. April wage growth grew by 3.6%, but April inflation was expected to come in at 4%, which means that, and again, and as we all know and have talked about, the CPI inflation isn't really it doesn't really give you a picture of what really gets felt, because it's covering so many areas, not just what we have to use: food, clothing, things like that. All of those things are being hit harder, which means actual inflation to the cash flow of households is generally more than 4%, because they'll cut back on the things that bring that average down. But if we've got wage growth being eaten up by inflation, and inflation higher than wage growth, that's a big shift from the last couple of years when wages had been growing. So that's excessively bearish too, as we start to just continue to see that we might be going into a time where we're already getting strained on inflation and gas prices haven't necessarily hit. One thing that I want to throw in here that I feel that is temporarily bullish, and certainly opening up some doors to kind of see what's going on, is that M2 money supply has actually spiked again, and it spiked over the last couple of years. Now, what does that mean? Well, we've talked about this a couple of years ago. When M2 money supply is there, it is a really bullish for risk assets. They love liquidity. Okay. Historically, stocks, crypto, speculative assets, and commodities all respond positively to expanding liquidity. And this is not something that is it's spiking more, but it's been spiking for the last 12 to 24 months. Liquidity is the oxygen of the markets. That right there is absolutely bullish. Asset inflation can continue even with weak growth. You can have a mediocre economy, and you can still have strong markets if liquidity rises. Markets don't need strong growth if they have strong liquidity. When you say, well, where would you invest right now? Now, we're not here to give investment advice, but stock prices tend to follow earnings. There are a number of places, if you're willing to peel back, open the hood and peel back and look for it, there are a number of places that you can put your money right now, where if you follow the trends, the EPS has continued to spike higher while stock prices for these particular individual stocks have actually shrunk, and to some degree the S&P 500 itself. The consensus going into next year is actually still sitting there at a really positive EPS growth. I'm trying to pull up my my baseline here of information, but I think looking into next year, we're looking at somewhere in the range of consensus calls for 19 and 16% EPS growth for the S&P 500 in 26 and 2027. So it's hard to be too bearish when EPS growth continues to go up, because stock prices have tended to follow the trend of EPS. And as I said, there's a number of stocks right now that if you look at EPS are highly undervalued. But again, that is a patient person's investment, because it doesn't mean you're going to get an instant return. Now, where else of investing? Again, if you're trying to be, look for diamonds, and you talked about, and again, I want to say this, Kirk, because you said gambling. Well, we've seen a massive spike in silver again. We are also seeing a spike in gold prices. Don't look today; they've dipped back a little bit. But I can't remember if I touched on this last week, but China's central bank is actually accelerating its gold purchases. April had an addition of 260,000 troy ounces, or 8 tons, the largest monthly purchase since December 2024. And that was their 18th consecutive monthly purchase. It brings their official holdings to a record to 2322. And that, again, if we come and look at February, I actually have a little chart here. I'll show it really quickly, but you can see what's happening to China's monthly gold reserve. Significant change that's just happened over the last 2 months. At the same time, the United States is actually having gold as our number one export right now. So, just to kind of look at that, we also had some comments, protective comments by Modi in India, to try to protect the Indian, the Indian Federal Reserve, that basically said stop buying gold. Well, that actually created a run on gold that caused gold prices to spike. Now, as you said, we saw silver prices absolutely plummet there, after a great run last year. So I am saying that, is there opportunity for gold to run? Yeah, if China's going to keep buying it, we're going to keep exporting it. If we're going to have the rest of the world, especially the emerging markets, fearing what could happen, financially in their countries, it could be very bullish for gold and for silver. By the way, China also accelerated silver as well. But would I say run and get it because that's a safe bet? Absolutely not. We've seen the reversal before. It doesn't take much to do that. And again, that would be something I would say is a gambling mentality, but possibly an opportunity for a run in those asset classes as well. Just a couple other things. I know we've seen gas prices jump, but ultimately the oil market lost nearly 1 billion barrels of supply by now. And given the time it takes to restart supply chains, this likely increases substantially further. Oil prices have risen, but they still have failed to reach the levels of 2022, a much smaller disruption. A couple of the reasons there that have been noted: oil markets had buffers at the start of the conflict, and the market persistently expects reopening of the strait. So there's still a lot of optimism in there. Seaborne oil exports from the U.S. surged up an unexpectedly large 3.8 MB to D. I forget exactly what that means, but let's just say, again, significant shipping in export from the United States year over year in the last 30 days. Million barrels per dollar. I think that's exactly what that means. And then China has been willing to let seaborne imports slide down about 5.5 million barrels year over year in the last 30 days, seeming to prefer to use their own inventories. And that has arguably shielded the rest of the world. But is this sustainable long run? That's a huge question mark. And it really has to do with at what point do they declare this conflict over? And it really is. I think that, again, this is not a long term play, but knowing that there's a lag there, oil prices is an area where there's probably going to be oil and gas futures, something that you're probably going to see a spike, or maybe not a fast spike, but a continual uptrend over the short term. But again, the reversal on that could come very fast and very hard if all of a sudden we start to get different metrics from the war on supply, et cetera. So this is something, I would be very cautious, even though there might be opportunity there. I'd be very, very cautious in looking at. Other than that, I mean, the consumer's feeling it. Okay, serious delinquent credit card balances are about to surpass the financial crisis record. We are not seeing homes move right now, and house payments as a percentage of median income are back where they were in 2008, 2009, second to where they were in the early 80s. So absolutely not a bullish outlook for housing. And we are also, again, over the last 5 years, I mean, I know you feel it. We are seeing 105% increase on coffee. Cheers to that. Willing to pay it, but I am making my own. Price of ground beef, 68%. Fuel oil up 63%. Auto insurance, 58%. Transportation, 43%. Gas, 43%. Gas utilities, 42%. A dozen eggs, 39%. I always laugh about this one because people freak out. It's still cheap. I mean, an egg can be an entire meal for 60 cents or less. Electricity, 39%. Home prices, 37%. Restaurants, shelter, family health, groceries, new cars, all over 20%. What does that mean? I mean, again, when we look at inflation only moving by a couple percent, all of those things I just mentioned there are mostly areas in which it's going to be really, really difficult to cut that out of your budget. And that means expect that we're going to start to see a pullback that can trickle through the economy that doesn't seem to be any signs of it freeing up anytime soon. And I think that, as I said before, Kirk, this is something where conflict is the summary here. A lot of conflicted data. Again, as earnings are strong, markets are probably going to push higher. But with producer prices exploding higher, and the U.S. 30-year yield now at 5.03%, there's only been a handful of days in the last 19 years, is now just 8 basis points from a new 19-year high, where the bond market is telling us there is reason to be concerned. I know you've got another chart I'll let you talk about how bifurcated the stock market is. But at the same time, we've got massive liquidity out there that's, in M2. But again, inflation, if, the bearish, what to look at there is that, inflation risk becomes huge when we have an M2 money supply, and it's already going up. Supply is constrained, labor tight, energy volatile. Inflation can reaccelerate, something that is absolutely not good for the Fed, and it puts them in a really difficult position to make decisions. It's not good for the presidency, which creates uncertainty as we go into the midterms. Asset bubbles can become more likely. Concentration increases, where liquidity can push these markets beyond fundamentals for longer than people can expect. And ultimately, that conflict there is something that, ultimately it's governments are running massive deficits, global spending aggressively, debt issuance injecting liquidity. The repo market is telling us to be concerned. Japan is telling us to be concerned again with the yen. And one of the big areas, as I said, China is quietly stimulating again. How long that continues? Well, when China slows, liquidity usually follows.
Yeah, we have a global challenge right now because of this war. And prior to the war, international was outperforming the U.S. And I know pretty much people don't invest in international, and this is not unique to the U.S. This is actually every country does this. They call it, local bias, right? So I know the U.S. markets. I'm going to invest in the U.S. markets. I'm not going to invest in Japan because I don't know Japan. People in Japan do the same thing. They know Japan, they're not going to invest in the US. There is a high percentage of people that only invest in their own country, which is fine. I mean, Peter Lynch said, invest in what you know. There's nothing wrong with that. But you should be aware that prior to the war, international markets were doing better. And last year they were doing better. Trump was, make America great again, but the best performing markets were not America. They were international. So not saying we did bad, but certainly the best performance were in other places. With the war going on, I'm not sure that's necessarily going to be the case, because a lot of these countries can't get oil and gas. It's really expensive. It's causing their economy to slow. So if anything, Trump is putting a brake on the global economy with this war, which I'm sure is not what he intended. If he is, I'd love to hear the reason, but at the moment, that's what's going on. So the thing to take away from this, certainly international markets are questionable. I would stay away from emerging markets. Oddly enough, the emerging market ETF includes China as a big piece of it. So it's kind of hard to invest in emerging markets when you have China, although there is one that has emerging markets ex-China, but the volume isn't quite as high to invest in it. So here's a positive takeaway. Okay, I know I've been talking a lot of negative today because it's just the way it is. But here's a positive takeaway. Earnings season has gone through like close to 90% of the companies, maybe a little bit more at this point, maybe 93 or something like that. But most of the earnings are done. Okay. And there's a really good growth of earnings so far. I want to say it was up from like 14 to 16% in the S&P 500. So earnings growth. That's really positive. Okay. And the expectation is that the returns by the end of the year are probably another 10% higher, 10 to 15% higher based on earnings growth. Now, I'm not saying that means the index is going to be that much higher, but if the markets are rational and earnings led to higher prices of a similar amount, then you can expect that. So out of all the negatives going on in the world, the positive is we had really good earnings growth in this past quarter, and at the end, for the start of Q2 earnings. So that's really good. People should feel good about that. Some companies, when they reported well, and their stock got taken out of the woodshed. Some companies reported and their stock went to the moon. It is a very weird quarter, but overall, there's some pretty good growth in the U.S. economy. Now, that being said, do I think that's going to continue next quarter? Probably not, because a lot of people are paying more for gas, which means they're paying less for other stuff. And so we'll have to see if that translates, higher gas taxes, higher oil and gas prices equals a tax. It's basically a tax on you. Okay. So there's an increased tax on you in the past few months. And the longer the war goes on and the higher oil prices, the more the tax is going to impact you. So that's a reduction of money you can spend on other things. So the thing to think about is, what are the areas that are going to benefit from this? Yeah, sure. AI potentially could grow. You have some IPOs coming out ideally in the next few months. I don't know when they're coming out. SpaceX, they want to launch, pun intended, in the next few months. Anthropic, OpenAI, there's a bunch of companies that want to go public in the next few months. You'd have to have a positive market for that to happen. If the market's melting down, they're probably not going to go public in that market. But a lot of people are looking to invest in that. So the speculation is, in the next few months, those will go public. I would suspect if they're trying to hold the markets up for that IPO, then the markets aren't going to hold up well past that, but we'll see. We do have an election season coming in the fall. I expect that will be just as polarizing as it has been for the last 10 years. And so you can probably expect a lot of fireworks. I will say, though, I have enjoyed the videos coming out of California for the people running for mayor. Brilliant videos. I forget the guy's name who's done the videos, but A+. I don't know anything about his policies, but for marketing, for campaigning, A+. Those videos are awesome. I love watching them. See, I just saw one this morning. it was like a Lego video, but instead of everything is awesome, if you ever saw the Lego movie, everything is awesome. Like he says, everything is awful. So it's brilliant campaigning. So A+ on the campaign strategy. So anyway, so I just wanted to kind of share the positive because I know we kind of talk about where all the risks are because that's really what you need to know. There are some positives, and that can lead to better future quarters in certain areas, but you got to be picky. Not everything's going up, right? There's certain areas that are not. I shared this a few minutes ago, but 10 stocks grow just shy of 70% of the 16% rally off the bottom, off March 30th bottom. That's it. 10 stocks. I thought it was more, but it was just 10 stocks. So understanding that should put things into context. Now, I'm not saying that you dump everything and buy those stocks. That's not what I'm saying. I'm saying that if you're looking for places to invest, understand the market is very narrow. A narrow market is a very unhealthy market. A broad-based market rally is very healthy. We do not have a broad-based one. We have a very narrow one. So another area I've been seeing, just touch on a few things before I hand it back to Doug. I've been seeing a lot of talk about TIPS. If you don't know what a TIP is, it's basically a Treasury inflation protected security, I think is what it translates into, the acronym. We've seen a huge amount of inflow into TIPS. I've been looking at the TIPS chart. There's nothing sexy about that. Personally, everybody talks about TIPS. They say, should I invest in TIPS? Oh my God, inflation. I will tell you, I'll be the first person to tell you, I intellectually, academically understand TIPS, but when it comes to market prices, it makes no sense to me. You'd think inflation's going up, TIPS should do better. They're going down. Today, they're down actually pretty sharp. I don't know what the percentage is, but they're down pretty sharply today. Why? I don't know. I tend to stay away from TIPS, just like anything in the markets. If you don't know anything about it, don't invest in it. You don't have to. There's plenty of things you can do. I'm not worried about inflation in that way. I'm not going to buy a 10-year TIP for inflation purposes. Maybe we repeat the 70s, maybe we don't. I have no idea. But I'm not worried about that because if I'm in short-term treasuries, those rates are going to keep climbing as long as yields go up. So, when they get high enough where I feel comfortable, I can lock them in for as long as I want, and then I'm good. But at the moment, I'm staying short-term. That's keeping me happy. And at some point, earlier this week, I thought we would get a point where the markets would hit the bottom and start to bounce up because we're really at the point where last year where we had the tariff, where Trump threatened all the tariffs. This is where the taco happened. The taco is Trump always chickens out. That's the phrase Wall Street uses, the taco trade. So everyone assumes Trump's going to chicken out right now. He's going to do whatever he needs to do to make sure that the rates don't go up. It doesn't look like that to me. So we'll see. Maybe he says something that causes rates to go back to a different level, but I don't think that's happening. I don't see anything in the cards at the moment based on what I'm seeing that's going to happen. So looks like rates are going higher. I would not be in long term. I would be in short term. Short term, the risk is as long as you hold it to maturity, then there's virtually no risk. And so, stick in the short term, you're getting like 4%, a little bit higher for short-term treasuries. If you're doing, drawing a blank on it, you can use the box strategy, which I can probably talk about at a later date. It's a little more complicated for most people. But if you do a box strategy, you can actually get a little bit more than that. Usually somewhere between 20 and 60 basis points higher than that. So you can get a better yield, but you got to lock it in a little bit. So there's some different things you can do, but I would be very careful about, over investing in this market. If you want to take chip shots, you want to try to take a little piece here, a little piece there, try your luck and try to start a position. That's fine. But, but basically here's another chart I wanted to share. Here's the earnings growth for the Mag 7 versus the S&P. The black or the gray is the S&P. The Mag 7 is the blue. Obviously, it's a lot higher which is why everybody's investing in Mag 7. Although the Mag 7 has not done particularly well in the last few weeks when semis did well. Here is something that should interest you. So if you look here, this is the semiconductor ETF, the SMH, and it is basically semiconductors. And if you look at this flow, there was a huge flow in, and now there's a huge flow out. So this looks to me like the smart money says, I'm taking my money and run. I'm going to take it off the table and let everybody else fight over it. That's what that's showing me. Does that mean that's true? Not necessarily. It could mean people are buying the individual stocks, could be people are buying options, anything, this only says the flow in and out of the ETF. These sort of things are interesting to me because it shows a data point that I could say, okay, let me do a little more digging. But in itself, it means nothing. Because if I saw this with the SPY, which is an ETF on the S&P 500, and there was a big outflow, I'd be like, oh my God, it's going to crash. No, maybe they put their money into the futures S&P 500. Maybe put it into the Vanguard Mutual Fund S&P 500. Maybe they put it into stocks. You don't know, right? All you're seeing is a single data point, which is not the full picture. So you can't draw a conclusion from a single data point. You have to look at the whole picture. And this is a single data point that says, all right, let me do some more explanation. That's what that says to me. I want to point out three or four more charts really quick and hand it back to Doug. First one, this thing has been floating around the internet in the last few days, coming out from Goldman Sachs, I believe it was. So I believe Goldman Sachs submitted this, although it shows up in Bloomberg, where this shows that at certain points, based on what we're seeing now, here is when problems start to happen in the oil markets. And, according to this is assuming there's no resolution at this point. Here's what's going to happen by September, by June. So basically in 2 weeks, we're going to start to see operational stress from the war. In September, it's basically everything's going to have to shut down because there's no room for extra capacity. I don't know if this is true or not, but it was interesting, and I just wanted to talk about it since people have been talking about it. That sounds like a scary chart. I tend to ignore those because it seems a little bit too marketing-esque to make themselves stick out and say, oh, look, we did this research. I will point this out, though. The global money supply, Doug alluded to it earlier. This is important, understanding this. You want to know why the markets did really well last year? Well, this is a pretty good indication. You want to know why they're doing well this year? This is a pretty good indication. Oddly enough, if you go back and look at money supply, when the money supply goes up, stock prices go up. When the money supply goes down, stock prices go down. It's normal. I mean, look at 2022. Pretty much went up a little bit, then it went down sharply. Oh, what happened in 22? Bonds and stocks lost a lot of money. So it's not 100% correlation one-to-one, but it is something you should watch. Obviously, this is floating around there as well. A lot of people are referencing this. It's important to keep in touch with the global money supply to see what's happening. I'll point this one out. This is a 30-year yield. This is showing it's just right around 5%. So we start going a little bit higher, and you're going back to the late aughts when interest rates were just shy of 5.5. But we're really getting to this pressure point where it's really a danger. So here's the thing I showed you before. Here's 2022, went from like 1.7 all the way up to pretty much a high of 5 on the 30-year. That's why it lost 50%, because of that huge spike up in interest rates. And because it's close to zero, it compounds the loss or gain, frankly. Now, if interest rates went from here down here, you would see an enormous gain on your treasuries. I'm not saying it will, but I'm saying if that happened, you would see a huge gain in your treasuries. So I'm not seeing inflation dropping that much. I'm seeing inflation going up at this point, not down. So just something to keep in mind. Let's see, one quick chart and then the last one. This is healthcare. This is a healthcare sector. It's done horrendously. This in red is this year. It has done horribly this year, and it's 8.3% of the S&P 500. So that's dragging the performance of the S&P because healthcare has been one of the worst performing sectors in the S&P this year. And we're not seeing signs of that changing. The last chart is showing the real rates. Now, These are inflation adjusted rates. I'm not going to get in the weeds with this, but just understand this does have an impact on prices of certain commodities, especially gold. And this does have an impact on a lot of different areas. So just something to keep in mind. We'll get into this in a future show, but it is something that is interesting that it's starting to get close to turning negative, and that will impact the economy in different ways. Doug, you can wrap us up here. We don't have too much time. Let's see. We got about 5 minutes. If you can say your piece and wrap it up.
Yeah, I mean, honestly, at this point, there's not a lot to add that I haven't already talked about. I mean,
Home
I
prices.
think,
You want to talk about that? You had a
yeah,
chart on home prices.
let's talk a little bit about that. Let me see if I can find.
I'll bring it up here.
Yeah. By the way, I did want to say this too. Sometimes when you're going live and you're jumping back and forth and you're trying to get your brain to work, MB/D million barrels per day. Don't know why it wasn't coming to me, but that just, it happens. So anyway, so that's what we were talking about, is the million that I was trying to talk about before with the oil production. Million barrels per day has spiked. House payments as a percentage of median income. Okay, so I talked about this a couple minutes ago a little bit. We are in a situation right now that if we look at and of course, this chart now is about 2 years old, which I find interesting because it only goes back to 2024. So it's a little bit of a chart crime. But we can see that, the house payments at that time, 39% of median income. And that had been, the average was right around 28%. And we've been times where we've been exceptionally valued. And that was really the case between, coming out of the Great Recession into really, right after post-COVID. And again, housing prices went up. People wondered why. Well, if you look at the average of cost, and we said this at the time, money was very easy in supply. M2 money was available. It was cheap to get. That drove housing prices up because there was, it allowed for higher demand. If we go back to the Great Recession and the housing collapse in the mid-aughts, at that point in time, we got to a point where the consumer was stretched, that they were in a position where, they were taking on more costs than they could afford. But also, one of the things that was very different then, and I'm not even talking about the early 80s when we're coming out of the stagflation era, but the big difference in the aughts was that most of the purchases out there and most home ownership out there was at least fairly, if not extremely, leveraged. It's not the case right now. We do have a situation where the buyers in the last 3 to 4 years are in an exceptionally difficult position. I have another chart there that shows where all debt delinquencies are spiking, and the one that really ramped up over the last year or so is in tuition payments. And that was something I was calling about a year and a half ago, because we saw that there was going to be a real impact to the consumer when they started charging on student loans again. Remember, there was basically a COVID pause there. Well, look what happened. Student loan delinquencies of 90 days plus from Q1 2025 just basically went from non-existent to 10%. Credit cards are closing in on 15%. Auto loans are now up to 6%, which, again, is high, but has still been fairly consistent going back to, really even, back to 2010. That hasn't changed a whole heck of a lot other than bouncing around. Home equity revolving credit has plummeted. Okay. So, and which is no surprise. This is the area where lots of people are sitting on their homes and lots paid off. The thing that, and if you, of course, look, mortgage delinquencies also have plummeted. Now, you can see they're starting to dip up a little bit, but fairly insignificant. I mean, certainly not insignificant for, if we look at nothing to something, but we're only talking 3%. But it'll be interesting to watch. What I will say about all of this is that the last payment that people are not going to make is their mortgage, is their residence. They do not want to lose shelter. So I don't look at student loans and I don't look at credit cards and I don't look at auto loans as significantly the most critical thing. They're not going to tank the economy. Mortgage loans delinquencies will. And we're not at a spot where that's necessarily going to occur. And it's not a huge risk to our economy right now. The others are certainly a sign of consumer stress, but they are not a sign of impending collapse because people stop paying their credit cards. They'll just get a lot of harassment notices. But there's nothing, they're not secured. There's nothing to take. Auto, tough, hard to get to your job if you can't work, but there's public transportation. But people don't want to lose their homes. The biggest issue is the majority of real estate right now in the country is fairly well paid off. We are not in a 2008 debt crisis. The problem is it's not moving. We just hit some of our lowest housing transactions in decades. And we're also seeing right now that the number of sellers out there to the number of buyers has significantly increased. What that means is where we went from no movement because things were stalled, people didn't want to sell, they didn't want to they don't want to take on higher interest, they don't want to downgrade from their homes. Baby boomers are getting older, deaths are going to happen. But we are seeing now, what'll be interesting to watch is as more homes hit the market, they're still pricing them at what they think they could have gotten, but the consumer doesn't have the financial means right now to get the loans, to get the financing, to get the liquidity to buy them. And that continues to put us in a significant stall in the real estate market. That will end up becoming painful if we get to a point in which we start to see accelerations of job losses. It will be painful if we start to see other erosion of cash flow that comes from high oil price and things like that. So to me, it's really interesting to look at, but it is also something that is not ominous yet. Good news, and I'll say this and move on to the close, is I pointed this out to my peers the other day. We did see that we are starting to see cuts in tuition. They announced the other day, Polymarket announced that they are actually looking at slashing the price of MBAs by as much as 50% due to falling demand. I have another chart that shows right now that we are peaking the number of 18-year-olds. I've been talking about this. That's going to decline. Less 18-year-olds means less kids going into college. And we're also starting to see less kids that are applying to graduate school, willing to take on certain degrees like MBAs, not as effective as they used to. And this could be a sign that maybe Trump's going to get a massive victory here. Because if on top of, less demand on degrees that are ineffective just organically, less students demanding those degrees by going into college in the first place, and ultimately the financial caps that are being put on the amount of money available for those degrees, and selective amounts of money based on whether those degrees are considered professional degrees or not. Remember, a family can no longer go out and get $300,000 of student loans from the Fed for an undergraduate degree. They are capped at $65,000 total. So if that's the case over 4 years, and families are now going to have to work harder to figure out where to get financing, you're not going to have this endless supply and demand. And we may be starting to see colleges finally and quickly, even though there's going to be a painful period, readjusting how they're going to be going about and charging for it. And we'll see. Maybe Trump gets his victory after all. So as we close today, here's the bigger picture that's starting to emerge. The economy is slowing. Housing is very constrained. Consumers becoming much more selective. Businesses are operating, but carefully. And the exact same time, global liquidity rising again. EPS, earnings per share, very, very strong and have continued to be. And stock prices tend to follow that. So if earnings are higher than where the relative stock price is, you should see stock prices continue to go up. And that's why markets feel strong. Markets can keep climbing long after the economy starts to lose momentum. By the way, we look at economic cycles, stock markets tend, the economy tends to soften before the markets, or markets, and we start to see changes occur. They do not always correlate all on top of each other. And hey, everything's just fine and dandy as long as liquidity keeps flowing. This is the part that people miss. They assume markets and economy are the same thing. They assume that a financial plan is just having the right investments and getting a better return. It's not. Markets move on liquidity, positioning, expectation. In some ways, just euphoria. Real life and bonds, by the way, which is why the bond market is so predictable, moves on cash flow, debt, income, affordability. And eventually, and this is the part that nobody knows, those two worlds always reconnect. And that's why this environment matters so much. Rising liquidity can create tremendous opportunity, but it can also create significant illusion, prestige. In other words, you can be completely and utterly tricked. It can push investors into believing risk disappeared when it may have just been delayed, and it can reset quicker than you can react. Emergent Advisors, we help families separate signal from noise by mapping the entire picture: income, assets, liabilities, taxes, college planning, retirement income. So your strategy isn't dependent on one market narrative staying true forever. Real confidence doesn't come from chasing momentum. It comes from understanding your structure before conditions change. And in markets like this, where liquidity is rising while the economy slows, clarity becomes incredibly valuable. And if you really want to understand where you actually stand and have a financial house that is put in order and stays that way forever, not where a market emotionally tells you where to stand, go check out mergentadvisors.net. That's MERGENT, MERGENT, mergentadvisors.net, and start the conversation, whether it's retirement, whether it's a major purchase, or whether it's playing for college in a way that's going to be able to protect everything else you've worked hard for. Because eventually perception and reality always meet. Speaking of meeting, we'll meet you again next Friday, and look forward to doing this again with you, Kirk.
Awesome. Well, thanks, Doug.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.